Hello and welcome back to another episode of the Investor Financing Podcast, and I'm your host, Beau Eckstein. And on today's show, we're going to talk about construction loans, all about construction loans. We're getting a lot of calls lately about people building, people acquiring land that want to build, and I'm going to go over the fundamentals of construction loans today on this episode. So we're going to specifically talk about residential, spec construction, and then multifamily. There's all different sorts of construction loans for industrial and all the different food groups and asset classes, but we're going to kind of focus on the residential food groups today. And when we're talking about spec construction for single family homes, it's a pretty simple process. It's really, what's the experience of the sponsor? Have they done any ground up construction? Have they done any extensive renovations in the past 36 months? You know, what's real estate owned? Do they own a sizable portfolio? If they're not the GC, who's the GC? Has the GC built in the area? And then it comes down to the numbers of the property. You know, what's the acquisition cost of the land? Maybe they already own it already and have a land loan. What are the soft costs to date? What have they put in for entitlements so far? And then what's the cost to build? And then what's the completed value? What do you anticipate the completed value to be? Those are the real numbers we need. And then the timeline for the build. Is it going to be a 12-month build, an 18-month build? Are you looking for an interest reserve so you don't have to make payments during construction? These are all the questions we need to know so we can best assess and find the best financing for you. Now, it's a similar process for multifamily ground up, except sometimes those are much bigger projects. You might be talking about a 20 or 30 or $40 million loan. But really, it's the same fundamental questions that we need to know. Where's the equity coming from? Are you forming a syndication, or is this just a joint venture? Or is it just you, the only sponsor in the transaction? And really just to lay the ground, sponsor's resume and track record. Like, what have you built in the past? Really comes down to that. I get a lot of calls and people want to build these 20-unit multifamily and they don't own any real estate and they've never done any construction. Can we still finance those type of transactions? Yes, but they're a lot more difficult, right? Because ground up construction is perceived to be a lot more challenging than these large renovation deals, even though it might even be easier to do these construction projects from the ground up.
You're listening to the Investor Financing Podcast. We'll be right back after this break.
Hi, Beau Eckstein here, and I want to thank you for being a patron of this YouTube channel, or if you're listening on iTunes, Stitcher, or any of those audio platforms, I want to give you my book for free that I just wrote. It's called Launch, Expand, or Buy Your Next Business Using SBA Financing. And you can simply go to thesbabook.com and you can receive a free copy of my book. That's thesbabook.com. And thanks so much for being a valuable listener or viewer of the show. And I hope you enjoy the book. It's a very short book. It goes into detail. You can read it very quickly and get a good overview of all the benefits of using SBA financing. So thanks so much, and I'll see you soon. So that's what we're looking for on these type of transactions, is really tell the story and what you can expect for leverage. For somebody that's seasoned and has some experience, you can get up to 90% LTC, loan to cost, typically about 65% loan to value, but up to 90% loan to cost is what you can see. Usually we see most of the projects between 80 to 85% loan to cost, but you can squeeze out for an experienced sponsor up to 90% LTC. And then there's also, on some of these bigger projects, you can put in the capital stack, there could be some PACE financing for these multifamily projects. There could be some tax credits. So we got to know what the capital stack is going to look like. But that's really how we start to assess and look at the financing and the capital stack structure is basically that information that we just went over right now. So it's pretty simple to kind of lay the grounds. I mean, right now, multifamily and residential is, especially multifamily, is definitely a product that people want to fund, or that mortgage companies want to fund. But at the same point, they're looking for more of the experienced sponsors for these type of transactions. Not to say that we can't get it done if you're lacking the experience, but that's why we have our funding assessment meetings, appointments. If you're interested and want to discuss a particular project, feel free to book a call below. We can talk about your project in depth, and it usually takes a couple days to get back to you as far as loan structure once we get the general information. Really, to get a pre-approval or a term sheet, sponsor's resume, personal financial statement. If you own the land already, we need a closing statement on the land. Soft costs spent to date, construction budget. If you got renderings and plans, we need those. And any comps, comparable sales in the marketplace, that would be good. If it's a multifamily, you can throw in a 3 to 5 year pro forma showing what the lease up's going to look like and what the anticipation of rents are for the stabilized value. But that's it. That's all we need to really kind of assess construction projects. If you have any questions, once again, feel free to book a call below. Look forward to talking to you, and have a great day.